7 days. That was the distance between the morning Roy Callahan's father looked at the standing corn and said, "Plow it under. We're done." And the afternoon, a county extension agent called the farm with news about a federal relief program that was opening an eligibility window for producers who had suffered losses in the 1986 crop year. 7 days. On one side of those 7 days, a field of corn that had been plowed under to avoid the cost of harvesting a crop that would sell for less than the fuel and labor required to combine it. A rational decision. A cost-cutting decision. The kind of decision that farm accountants in 1986 described as cutting losses and that every farmer in Wayne County, Indiana understood. On the other side, a federal relief program that required applicants to document their production losses with scale tickets, elevator receipts, or other evidence of harvested yield. Evidence the Callahan family no longer had, because they had plowed the corn into the ground 7 days before they knew they would need to prove it existed. The 1986 crop year had been building toward failure since the winter. Corn prices had been falling since mid-1985, and by planting time in the spring of 1986, the futures market was offering prices that left little margin for error on a cash rent operation. Roy's father, Bernard Callahan, had farmed 480 acres in Wayne County for 22 years. 200 owned and 280 rented, and he had seen difficult years before. But the combination of input costs from the previous year's operating loan and the forward price on corn had produced a break-even analysis that made 1986 look like a year where everything had to go right. Everything did not go right. The growing season was adequate. Yields were not catastrophic. The plants had grown. The ears had filled. The problem was price. By September 1986, corn at the Wayne County elevators was trading near $1.45 per bushel. Bernard's break-even, accounting for cash rent, operating loan interest, and harvest costs, was $2.20 per bushel. At $1.45, every bushel he harvested and sold would lose 75 cents. On a projected yield of 110 bushels per acre across 480 acres, 52,800 bushels, harvesting and selling the full crop would generate a cash loss of approximately $39,600 on top of the production costs already spent. Bernard's operating lender had been watching the accounts. In late September, the lender had indicated that it would work with him on the year-end balance, but needed to see that Bernard was managing his expenses carefully. The conversation had been professional but pointed. The lender was concerned about the portfolio and wanted to see evidence of cost management. Harvesting corn that would sell for 75 cents per bushel below cost was not cost management. It was adding loss to loss. Bernard talked to Roy in the first week of October. Roy had been farming alongside his father since 1979 and understood the numbers as well as Bernard did. The conversation was short. The math was clear. The corn was standing in the field, mature, dryable, combinable, but not worth combining. Bernard called the custom operator, who had been harvesting their ground, and canceled the harvest contract. He called the lender and explained the decision. He arranged for a neighbor with a large tillage tractor to plow the standing corn under, incorporating the stalks and ears into the soil, returning the organic matter, closing out the crop year without the additional expense of harvesting a losing crop. The neighbor ran the tillage through the Callahan fields in the second week of October 1986. The corn was gone. 7 days later, the extension agent called. The federal relief program that the extension agent described had been announced by the USDA the previous week and was being administered through the county FSA offices. It provided direct payments to producers who could document crop production losses in eligible counties for the 1986 crop year. Wayne County was on the eligible list. The payment formula was based on the difference between a producer's established yield history and their actual 1986 production, multiplied by a per bushel rate. The extension agent walked Roy through the eligibility requirements. To qualify, a producer needed to submit documentation of actual 1986 production. The program required one or more of the following: scale tickets from elevator deliveries showing the weight and grade of grain delivered, elevator settlement sheets, commercial storage receipts, or in limited circumstances, other verifiable evidence of harvested production such as custom harvest invoices or FSA acreage reports, cross-referenced with yield estimates. Roy told the agent that the family had not harvested the corn. The agent paused. Roy explained. The price had been below break-even. The decision had been made in early October to plow under rather than harvest at a loss, and the tillage had already been done. The agent asked whether they had any scale tickets or elevator receipts from the 1986 crop. Roy said no. They had not delivered any grain because they had not harvested any grain. The agent said he would check with the county FSA office about whether an alternative documentation pathway was available and would call back. He called back 2 days later. The FSA office had reviewed the situation and confirmed that the standard proof of production requirements applied. Without scale tickets, elevator receipts, or equivalent documentation of actual harvested production, the Callahan family did not meet the eligibility documentation requirements for the relief program. The program was designed to compensate producers for production losses, the difference between what they grew and what they normally grew, and the documentation requirement existed to verify that the production had occurred and had been lost to price conditions rather than to other causes. A crop that had been plowed under before harvest had not generated documented production. The FSA had no mechanism to verify what the field might have yielded. A producer's estimate of what the yield would have been was not an acceptable substitute for actual production evidence under the program's rules. The Callahan family did not qualify. Across the county road from the Callahan farm, a neighbor named Earl Stinson had also faced the same price calculation in September 1986. Earl's corn was the same variety, planted at the same time, on soil with a similar production history. Earl's break-even analysis had reached approximately the same conclusion as Bernard's. Harvesting at $1.45 per bushel was going to generate a cash loss. Earl had harvested anyway, not because the economics had looked better to him. They had looked the same. Earl had harvested because his wife had suggested, when they discussed the decision, that they should have paperwork. She had read something in a farm publication about the possibility of a relief program and had mentioned without certainty that having the grain on record seemed like it might matter. Earl had not been convinced the program would materialize, but he had been tired of arguing and had called the custom operator. The harvest had taken 4 days. The corn had averaged 108 bushels per acre on Earl's ground, 51,840 bushels. He had trucked it to the elevator and accepted $1.43 per bushel. The basis had weakened slightly in the days between harvest and delivery. The settlement sheets showed a total of $74,131 for the delivered grain, against estimated input and harvest costs of approximately $114,000. The cash loss was real and documented. When the extension agent called Earl about the relief program, Earl had his scale tickets in a folder on the kitchen table. He filed his application with the Wayne County FSA office in November 1986. His payment was calculated at the difference between his approved production history yield and his actual 1986 yield, multiplied by the program's per bushel rate. The payment was $18,400. Bernard Callahan received nothing. The Callahan family filed an appeal with the Wayne County FSA Committee in December 1986. Roy prepared a written statement describing the family's decision-making process. The price analysis, the break-even calculation, the lender conversation, the decision to plow under as a cost management measure. He attached the tillage invoice from the neighbor who had done the work, showing the date and the acreage. He attached the canceled harvest contract with the custom operator. He attached Bernard's FSA acreage report, which documented the planted acres and the expected yield based on historical data. The committee reviewed the appeal materials. The appeal was denied. The committee's written response acknowledged that the Callahan family had planted and grown a corn crop on the documented acreage. It acknowledged that the crop had been destroyed by incorporation into the soil rather than by harvest. It noted that the program's documentation requirements were established to verify actual production losses and that the available records, acreage report, tillage invoice, canceled harvest contract, established that a crop had been planted and subsequently destroyed, but did not establish the actual production level that the payment formula required. Without a documented yield, the payment formula could not be applied. The appeal was denied. Roy drove home from the FSA office in Richmond and told his father. Bernard sat at the kitchen table with the denied appeal letter and said nothing for a long time. The proof of production requirement that had disqualified the Callahans was not a technical trap inserted to catch farmers who made the wrong decision. It reflected a design principle that applied to virtually every federal commodity program that paid producers based on production levels. The program needed to know what the production actually was before it could calculate the payment. Production evidence in the farm commodity context serves a function that goes beyond accounting. It is the mechanism by which programs distinguish between a genuine production loss, a crop that was grown, harvested, and sold below cost, and a crop that was not grown, or was grown poorly, or was destroyed for reasons unrelated to market conditions. Without production documentation, a program that paid based on the difference between historical yields and current yields could not verify whether a claimant had actually produced a crop at all. The specific documents the program required, scale tickets, elevator receipts, settlement sheets, existed in the ordinary course of commercial grain sales. A farmer who harvested corn and delivered it to an elevator received these documents automatically. They were not something a farmer had to plan to obtain. They were a byproduct of the transaction. A farmer who did not deliver grain to an elevator did not receive them. Not because the farmer had done anything wrong, but because the transaction that generated the documents had not occurred. The Callahan family's decision to plow under was economically rational by every measure Bernard had applied to it. At $1.45 per bushel, with a $2.20 break-even, harvesting the crop would have deepened the loss. The decision to avoid that additional loss was the kind of careful cost management that agricultural economists described as appropriate crisis-era behavior. What Bernard had not factored into the analysis was program eligibility. He had made a harvest or plow decision based on the economics of the 1986 crop year without knowing that the eligibility criteria for a relief program announced a week later would be built around evidence that harvesting would have generated. He had not been careless. He had been operating with the information available to him in early October 1986. The program announcement came in mid-October 1986. The tillage had been done in the second week of October. Earl Stinson's wife had read something in a farm publication. Earl had not wanted to harvest. He had harvested anyway. He had the scale tickets. Bernard had made the rational decision. Earl had made the documented decision. In 1986, the program paid for documented decisions. It did not pay for rational ones. Bernard had not lost because the price was wrong. He had lost because the combine had not run. And without the combine, there were no tickets. And without the tickets, there was no proof. And without the proof, there was no payment. They had not lost because of the price. They had lost because they had no paper to show what the price had done to them.